Discord had two clean exits: get acquired or go public. By saying no and waiting, it tried to keep both. But strategic disasters often look like flexibility, right up until the day one key stops turning. In April 2021, Jason Citron sent a message to his employees. It was not a product announcement, it was not a hiring update. It was a note explaining that Discord had been in acquisition talks with Microsoft, talks that had gone far enough to generate a reported valuation of around $12 billion, and that the company had decided to walk away. The decision was framed as a commitment to independence. Discord would pursue its own path. It would build something larger than what any acquirer had offered. The platform had more than 150 million registered users at the time, and it was growing faster than almost any consumer technology product of the previous decade. The pandemic had sent millions of people into homes where voice chat, server-based communities, and persistent group messaging were suddenly not niche tools for gamers but infrastructure for how people worked, studied, organized, and stayed connected. The timing, by any external measure, looked good. Microsoft had offered $12 billion for a company that had been founded 6 years earlier with the modest goal of building better voice chat for online gaming. The offer reflected the moment as much as the asset. It was April 2021. The technology acquisition market was running at conditions that would not repeat, and Microsoft had the strategic logic and the balance sheet to close the deal immediately. Discord said no. The company that Citron had built from a small gaming utility into a platform used by programmers, artists, educators, crypto communities, and tens of millions of general internet users had been valued privately at $15 billion by July 2021, when it closed a $500 million funding round led by Dragoneer Investment Group. The round implied a simple message. Discord believed its independent trajectory was worth more than what Microsoft had put on the table, and the investors who wrote the checks agreed. The $15 billion valuation established a benchmark. It was not just a number for fundraising purposes. It was a claim about the future, a claim that Discord's path to a public market, or to a larger acquisition, would eventually clear that bar and produce returns that justified passing on the Microsoft offer. For the investors in the 2021 round, for the employees who held equity, and for Citron himself, the $15 billion was the floor, not the ceiling. What happened to that floor over the following 4 years is what the record documents. Discord's growth story in the years after the Microsoft rejection was real. The platform continued to expand. Monthly active users, which had been around 150 million in early 2021, grew to 200 million and beyond by 2025. The product suite expanded well past its gaming origins: server discovery features, forum channels, text and voice integration, and eventually advertising tools and monetization mechanics that attempted to convert the platform's scale into sustainable revenue. The revenue grew. Discord generated an estimated $600 million in annual recurring revenue in 2023 and approximately $725 million in 2024, growing at roughly 21% year over year. For a consumer platform with 200 million monthly active users, those figures represented genuine scale. But the revenue per user told a different story. Discord's monetization had been built almost entirely on Nitro, a premium subscription tier that offered quality-of-life improvements for users who wanted higher streaming resolution, larger file uploads, animated profile elements, and server boosts. Nitro was a product designed around aesthetic and functional enhancements for engaged users. It was not designed around advertising, commerce, or data monetization. That was, by intention, part of Discord's identity, a platform where users paid for features, not where advertisers paid to reach users. The arithmetic of that model at scale produced a structural constraint. Discord generated approximately $3.50 per monthly active user per year. Twitter, even through its most turbulent periods, generated around $35 per user. Snap generated roughly $10. The gap between Discord's user count and its monetization rate was not a temporary inefficiency waiting to be closed. It was a direct consequence of a product philosophy that had been the foundation of the platform's community trust. In April and October 2024, Discord introduced sponsored quests and video quests, advertising formats that integrated brand campaigns directly into the user experience, requiring users to perform specific in-platform actions to unlock promotional rewards. The formats generated revenue and expanded Discord's advertising capability. They also generated visible friction with a user base that had joined the platform partly because it was not an advertising environment. The social contract that Discord's design had implied for nearly a decade was, at least in perception, being renegotiated. Meanwhile, the cost structure of the company had accumulated in ways that the 2021 growth environment had made seem sustainable, and the 2023 correction had made obviously not. Discord had hired aggressively through 2020, 2021, and into 2022. The headcount growth tracked the valuation trajectory. Both reflected assumptions about a revenue curve and a market environment that changed faster than the internal planning cycles had modeled. In January 2024, Discord announced it was laying off 17% of its workforce. The memo from Citron acknowledged directly that the company had grown headcount too quickly over the prior 2 years. The language was familiar to anyone who had been reading technology company announcements since the Federal Reserve began raising rates in early 2022. The explanation was accurate. The pattern was not unique to Discord, but for a platform whose community identity was built around stability, continuity, and anti-corporate sensibility, the announcement landed with particular weight. 17% of a technology company's workforce in a single action is a significant reduction. For Discord's users, it was also a signal, not about a quarterly earnings target or a Wall Street expectation, but about the gap between what the company had believed about its growth trajectory in 2021 and what the operating reality of 2024 required. This is where the decision to decline the Microsoft acquisition in 2021 begins to register in the financial record in concrete terms. Microsoft offered $12 billion in April 2021. Discord rejected that figure and raised at $15 billion 3 months later. The implied message of that sequence was that the company's leadership and its investors assessed the independent path as more valuable than the acquisition price by at least $3 billion, and likely by a substantial multiple of that if the IPO trajectory they were anticipating had materialized. The IPO did not materialize. Not in 2021, not in 2022, not in 2023, not in 2024. It was discussed repeatedly in those years. Citron referenced it. Advisors were engaged periodically. The company worked with Goldman Sachs and JPMorgan on preliminary conversations, but the actual filing did not come. The market environment that had made a $15 billion IPO plausible in 2021 was gone by 2022 and had not returned, for Discord's specific financial profile, by the time the company was finally ready to move. By the time Discord filed its confidential IPO paperwork in January 2026, the secondary market for its shares told a story that the $15 billion private valuation had never anticipated. Caplight Technologies, which tracks secondary market transactions for private company equity, showed Discord shares trading at prices that implied a valuation of approximately $6.8 to $8 billion, half the 2021 benchmark. A fraction of what the Microsoft offer had been, measured against the same company at a much larger scale, with 4 more years of product development and user growth. Conservative analyst estimates in early 2026 placed Discord's fair value at $5 to $6 billion based on revenue multiples of 7 to 12 times. Bull case projections argued for up to $25 billion, contingent on the company demonstrating a credible path to profitability and a monetization rate significantly above its current per-user figures. The spread between those estimates, $5 billion at the low end, $25 billion at the high end, was, as one analyst noted, less a valuation range than a description of fundamental uncertainty about the business model. The IPO that Discord had been pointing toward since 2021 was now arriving, in early 2026, into a market being asked to price a company whose core revenue mechanism was subscription-based cosmetic enhancements for a platform that had not yet demonstrated it could monetize at anything approaching the rates of its social media peers. The $15 billion floor that the 2021 investors had established as their entry point was, by secondary market evidence, no longer a floor. There was a leadership transition embedded in this timeline that the record does not allow to be left aside. Jason Citron, who had founded Discord and had been its chief executive through its entire history, stepped down from the role in April 2025. He was replaced by Humam Sakhnini, who had previously served as vice chairman of Activision Blizzard. Citron's departure came at a moment when the IPO process was already in progress. Goldman Sachs and JPMorgan had been engaged in March 2025, a month before he left, and was framed publicly as a transition designed to position the company for its next phase. A founder's departure ahead of a company's first major public market moment is not automatically a negative signal. But the timing placed Sakhnini in the position of guiding a company he had not built, through an IPO process he had not initiated, with a product philosophy he had not designed, into a market that was being asked to validate a $15 billion private benchmark that the founder who had set it had just left. The decision that cost billions, the accumulated cost of declining $12 billion in 2021 and then failing to execute a public offering at $15 billion before the market repriced, did not announce itself as a single error at a single moment. It assembled itself across 4 years of choices that each had internal logic and none of which appeared, individually, to be catastrophic. The choice to decline Microsoft made sense in the context of 2021. Discord's growth rate was extraordinary. The IPO market was at its most receptive in 2 decades. The $15 billion valuation from Dragoneer was not a speculative number. It reflected genuine investor conviction at a moment when capital was cheap and growth companies were receiving premiums that had no historical precedent. The logic of independence, of building the platform on its own terms, of capturing a public market outcome larger than what any acquirer had offered, was not irrational. What made it costly was not the decision itself, but the absence of the follow-through that the decision required. Declining a $12 billion acquisition in April 2021 and raising it $15 billion in July 2021 was a bet that Discord would either be acquired at a higher price or go public at a higher valuation within a reasonable time frame. The interest rate environment that made that valuation possible was not guaranteed. The IPO window that would have allowed Discord to lock in that benchmark as permanent capital was not permanent. The window was open through most of 2021. Other companies moved through it. Coinbase in April, Roblox in March, UiPath in April. Discord was in the right place, with the right advisors, with the right revenue trajectory to have joined that cohort. The filing never came. By 2026, the regulatory environment around large consumer platforms had also shifted in ways that complicated the IPO picture beyond the pure financial calculus. Discord was navigating a child safety and age verification challenge that had become, by early 2026, a visible pressure point. Discord's own data showed that more than 530,000 accounts had been disabled for child safety violations in a single quarter. A third-party security breach, related to an age verification vendor the company had engaged, had exposed the government identification documents of approximately 70,000 Discord users in early 2026. The rollout of a global age verification system, originally planned for March 2026, was delayed to the second half of the year after user backlash over facial scanning and identification requirements. The company's co-founder and chief technology officer, Stanislav Vishnevsky, acknowledged publicly that Discord had missed the mark in its approach to the rollout. The phrase was accurate and precise, but it was also the last thing an IPO process needed as context: a major safety controversy, a data breach, a policy reversal, and a public admission of misjudgment, all within weeks of the confidential S-1 filing. Institutional investors evaluating a consumer platform IPO in 2026 were operating in an environment where regulatory risk around social media and communication platforms had been a demonstrated, not theoretical concern for several years. Congressional hearings, FTC scrutiny, EU Digital Services Act obligations, and ongoing litigation around content moderation liability had created a risk profile for large-scale social platforms that had not existed in the same form in 2021. Discord's age verification controversy arrived into that context at precisely the moment the company needed to be projecting operational stability. The valuation gap between where Discord stood and where it needed to be for the IPO to vindicate the 2021 decisions was not insurmountable. A revenue of $879 million in 2025, growing at 21%, with 200 million monthly active users and a clear market position, was a legitimate business. Goldman Sachs and JPMorgan had taken the mandate. The filing was in. The process was real. What the process was not was the process that Jason Citron had described to his employees in April 2021, when he declined $12 billion and pointed toward an independent future. That future had been priced at $15 billion by the most sophisticated investors in the world, 3 months after the Microsoft offer. The secondary market in January 2026 was pricing it at roughly half that. It is worth noting, for context, that Discord's story in this regard shares structural features with others that have moved through this channel recently. The gap between peak private valuations set in 2021 and the market reality facing those same companies when they finally approached public markets had been a recurring pattern. The specific conditions of 2021, the rate environment, the liquidity surplus, the appetite for high multiple growth assets, had produced private benchmarks that the market of 2025 and 2026 was reassessing with different assumptions. Discord arrived at this reassessment with a more complicated picture than some peers, because the Microsoft decision had set the minimum acceptable outcome at a number that required a specific market environment to achieve. That environment had existed, it had been available, Discord had been positioned to use it. The confidential S-1 sitting with the SEC in January 2026 with Goldman Sachs and JPMorgan listed as underwriters was the company's first formal step toward the public market it had been promising since 2021. Whether it would price at $5 billion or $15 billion or somewhere between would tell the final chapter of what the April 2021 decision had cost, not in theory, but in the terms that investment agreements and public market filings make permanent. The hearings from that process, when they become part of the public record, will have their own answer.